I think you get into trouble when you try to make money really quickly. Options and leverage and very speculative type businesses. When you start with a relatively small amount of capital, I remember when I had a few $1,000s of investment capital, you want to kind of make money quickly. I think one of the important things to understand is the power of compounding. Berkshire Hathaway stock was like $48 a share, in the 1960s. You've become a millionaire investing with Warren, just buying a share kind of back then, but it didn't happen overnight. So the key is buying businesses that you believe will compound at a high rate over a long period of time. And, the consumer, often has insights before Wall Street. I mean, Tesla, the company, was appreciated. The big shareholders were retail investors because institutions didn't understand how great Tesla was as a company, as a car. So look for those experiences, products in your life run by companies or built by companies that you admire, and that's a good place to start. And then read the annual report, see what they say about their business, and then think about it. Is this a business that you believe can withstand competition? Seeing the future is very often just studying the present and looking for examples in history. And, in 2008, really before 2008, was several years before 2008, we saw a number of companies doing stuff we thought was crazy, which is there were these businesses called bond insurers, and they had AAA ratings, which means, as good as the government in terms of creditworthiness. And they were guaranteeing very risky mortgages and collecting money and reporting big profits. And we said, this is not sustainable. And that was not so much predicting the future, but identifying something now that just seemed wrong. And we knew eventually that would, if you will, that would blow up. In terms of predicting the future, markets are going to be volatile. There'll be some upcoming panic about markets. I don't know exactly what the catalyst is going to be. There is a ton of speculation. There's a huge amount of leverage being used by professional investors, by retail investors. My biggest piece of advice to your audience is don't borrow money against stocks, because that's how you get wiped out. And betting on sports is not great unless you've got some real edge. I think a lot of the younger generation is wasting a lot of money betting on sports. Maybe it's fun, but don't bet money that you need to live on.
If somebody had $1,000 to invest right now, where should they put it?
I would find a handful of businesses that don't use a lot of leverage. So you want companies that don't use a lot of financial leverage. They're businesses that you like and admire that make good decisions over time. And a business where you believe if the stock market were to shut for 10 years, you'd still be happy to own it 10 years from now. Don't invest in kind of what seems to be most exciting now. Invest in something that you believe will withstand the test of time, because the value of a business is the present value of the cash it generates over its life. And you have to be able to predict it's going to be around a long time. Our approach is to find what we believe to be the best businesses in the world, businesses that will survive the test of time, businesses that will survive the disruption of AI, will be beneficiaries at a minimum, will be either neutral or beneficiaries of AI. And so our portfolio, is comprised in some cases of companies we've always wanted to own, but weren't cheap until more recently. I put Amazon on that list, Meta on that list, Uber on that list, Microsoft, businesses that we've always admired were always too expensive. And a lot of money in the markets is flowing toward kind of the new thing, stocks, semiconductor stocks or memory or, places where people have recently made money. And we focus on where we're going to earn a high compound return over the next 3, 4, 5 years. And that's enabled us to fill a portfolio with these very high quality, what we call durable compounders. Apple has not been the most innovative company in the last decade. It's still an amazing business, but I don't even remember which iPhone I have. And I don't think it's materially better than the iPhone I had a few versions ago. The one I had before, actually a few iPhones ago, was better because the battery life was better than the one I have now. Some people are making the argument that this notion of walking around a phone, 5 or 10 years from now, you're not going to walk around with a phone anymore. You're just going to be connected. And you don't have to carry this device that you can lose or people can steal. You'll just have some, a little pin on your shirt that will pick up, answer all your questions.
Or maybe even in your brain.
Yeah. Actually, it's an area that I've been spending some time on recently. There are a number of companies working on kind of brain, computer interfaces. And it's going to be amazing for people with brain injuries and people who've lost vision. And eventually, I think you're right. I think maybe you'll wear a hat and the hat will be your connection to the internet. People think about stocks and bonds, right? Bonds, you get paid a coupon, an interest rate, a couple times a year. And if it's a fixed rate bond, you're going to get your 6 or 7% for sure. And at the end of the life of the bond, you're going to get your principal as long as it's a creditworthy company. A business is a bit like a bond as well, except the coupon, the interest payment, is not known. You have to estimate what it's going to be. And the interest payment, a way to think about it, the way we think about companies is we think about the earnings as the sort of the yield on the business. So people talk about PE, right? A stock's trading at a PE 20. Well, if you flip over the PE, it's a 5% earnings yield. One way to think about it is you're investing in a company that's generating a 5% return on your investment today. And the question is that 5% yield going to grow over time? Or is someone going to come up with a business that disrupts it and the company's going to disappear? And so, stocks are riskier than bonds because there isn't the same degree of certainty about their future. But if you narrow down the universe of companies you invest in to these really predictable, businesses where their market position is, we believe, so dominant, you can earn well in excess of bond-like returns without taking a ton of risk. For a business where are you spending your time? And, Amazon. I order from Amazon every time I learn about a new book. Going to the pharmacy in New York City has got to be about the worst experience, right? All the stuff's hidden behind plastic, and you have to call a salesperson to open a thing to get a razor blade. Okay. Meanwhile, you go on Amazon and get it delivered in 2 hours. And who can compete with that, right? So think about great dominant business where the probability of competition is extremely low.
Why wouldn't you suggest borrowing against your portfolio so you wouldn't have to sell your equities?
The problem is that stocks can trade at any price in the short term. And when you borrow against your equity portfolio, you can get a margin call. And what that means is, if you're living off your brokerage account and you've got, 50 cents leverage against the dollar portfolio, the stock market goes down 20% or your portfolio goes down 20, 30%, you have to post more collateral. They can sell you out. And the key to being a successful long-term investor is being able to survive those kind of challenging market periods when everyone else is panicking. In fact, you want to have money to invest when others are panicking. We've made a big chunk of our profits over the last, 20 odd years have come from times where the market was blowing up and we had hedged that risk and we had capital to deploy. I think what we do is actually relatively low risk. We buy very high quality companies. We own them for the long term. We get pretty deeply involved in those companies and help them be successful. So we'll occasionally join boards, but we'll always, I would say, have management's ear to the extent we have ideas that can help a business, be successful. The vehicle we manage, PSUS, you can think of it as a hedge fund, but it's one of the only publicly traded hedge funds. It happens to be available at this very moment at a very attractive price. So, if you like Microsoft, let's see. Microsoft right now is trading at, let's pull it up the ticker. Microsoft today is trading at $387. Well, if you want to buy it at $310, well, you just buy PSUS because PSUS is trading at a 22% discount to the value of its assets. So it's a publicly traded fund that trades in the stock market, and it trades based on supply and demand for the shares in the short term. The assets we own are worth almost $50 a share, and the stock's about a 22% discount.